Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review, this time for the week ending February 16, 2024. Looking at the markets this week, mostly positive returns. We've had a very busy week with inflation coming hotter on the CPI in the US early in the week, creating some volatility. After that, retail sales coming in weaker, so bringing some risk appetite into the market because maybe that would cause the Fed to cut earlier. And now this morning we had the PPI, which was hotter than expected. So lots of volatility, but still the market is in a good mood. So we're seeing an accumulation of good returns continue for equities during the week. Oil higher, USD stronger versus the CAD, the euro, and the price of gold this week. So getting into the data now, we had an interesting week in the US. So inflation a bit hotter than expected in January. On the left-hand side, you can see now the story that we've been discussing for a while, that it's kind of easy to bring inflation from 8 to 3, but from 3 to 2 is going to be tough. And we're starting to see that. It seems that there's a hard floor now on the, at 3%, so it's going to be hard for central banks to bring inflation down to target. Thus, the importance of staying the course and keeping going on the fight versus inflation. But if you look at the super core measure here, which is services CPI excluding shelter, which is closer to what let's say people feel is the inflation rate out there, well, we're seeing a resurgence. And if I had showed you here the 3 months annualized chart, you would see that in the last 3 months it's at an annualized pace of 6.7% now, the rebound that we're seeing for super core inflation. So interesting data. The Fed looking at it, and any central bank looking at that, cannot really feel confident that it's time to get going with monetary policy normalization yet. On the right, you have retail sales, which honestly disappointed here, but we tend to fade this number in-house because the seasonality adjustments for January were expected to weigh on the measure, and also weather in the US was harsh in January, so we're expecting a weak figure. So we're not really making a lot out of that. But if we now zoom out and look at the bigger picture, here on the left you see economic surprises. You have the world, which is in gray, and the US in blue. So you can see the US exceptionalism at work here. Economic data in the US has been pretty strong recently, but you see the trend is higher for economic surprises in the world and in the US. That's on the left-hand chart. So this is where we're at. Economy a bit hotter than expected. So maybe keeping central banks, back instead of, plunging to cut rates to support the economy. On the right, you have the inflation surprises. They've been trending lower. They're still in negative territory, but if you look carefully, you're starting to see maybe what looks like the start of a bottoming process here. So are we about to see inflation reaccelerate? We have some good indications that suggest that it could be the case. Will we be rebounding to much higher level, or just staying stubborn around 3.5%? This is the likely scenario that we are working with. We think that inflation will remain at these levels for a good while and pushing back those rate cuts from central banks. But the rest of the year will be very interesting on the macro front for sure. So the macro volatility that we've been discussing for a while, we're both feet in it right now. So markets, it's all about central banks so far in 2024. So if you look on both sides here, you have the Fed on the left, the Bank of Canada on the right. I always bring this chart because this is where the story is. Now, at the end of this week, or at least on Friday morning, could always move during the day. In the US, it's 3.6 cuts that are expected by the end of the year. And first cut is fully priced in by June 2024. 3.6 cuts is much closer to our base case scenario of about 2-3 cuts in the US by the end of this year, which would start around mid-year. So not completely uncomfortable with the first cut price in January, although we think maybe it's going to be pushed back a little bit. And we're far from the 7 cuts that were priced in the middle of January. So it's more reasonable, but we think there's still potential for repricing of those cuts. When you look at Canada now, the first cut is priced between June and September, which is, we think, reasonable. We have penciled in the July meeting from the Bank of Canada as the candidate for the first cut as data stands today, because there will be a monetary policy report and there will be everything that comes from the Bank of Canada at that meeting. So it could be a good candidate. By the end of this year, about 3 cuts priced in. We think that's fair. So pricing is fair in Canada. In the US, there still may be some room to run here to adjust. So the result here, as you can see in this chart, is that volatility is more prevalent now in long duration sovereign bonds rather than equities. So two things here. We'll look at the standard deviation of the 90-day standard deviation of the daily returns of the TLT ETF for long duration bonds and the SPY ETF for equities. And so TLT is blue and SPY is gray. So as you can see here, typically, the realized volatility tends to go hand in hand between these two products, except when there's a market event, and then you see volatility spike up much higher for equities rather than long duration bonds. And what we're seeing here is an interesting divergence between the realized volatility of long duration sovereign bonds versus equities. So people are seeing more risk, or investors are seeing more risk in long duration bonds rather than in equities. So we think that the volatility that we're seeing in long duration bonds is fair because of what's going on in the markets and the repricing of monetary policy. Likely it's the realized volatility of equities that is pretty subdued. So when we say that the markets might be priced in for perfection. So that wraps it up for the week. What to watch next week: CPI, inflation, and retail sales in Canada. In the US, the meeting minutes from the FOMC January 31st meeting, PMI for manufacturing and services sector from the S&P Global, and we'll have existing home sales in the US. So if you want to find us, ia.ca/economy, iagan.ca/insights. Lots of material for everyone here. Thank you for following us on a weekly basis, and I'll be back again next week.